Well, good afternoon, everybody, and welcome to the Wednesday Lunchtime Drive-Thru on this Wednesday, June the 2nd, 2021. Can you believe it is June? It is summertime. Technically, I guess it's not summertime, but still springtime. We have not yet had the summer solstice, the longest day of the year, and the northern hemisphere anyway. So that's coming up soon. But here in Oklahoma, it's unseasonably cool for this time of the year, but I love it. I love it. I love it cold. I like cold temperatures. Fall and winter are my favorite months. I know many of you are like, you are sick and twisted, Damon King. Why would you ever say such a thing? But I like what I like. So there you go. All right. Well, today we are going to be talking about 5 times when a Roth conversion pays off the most. And don't you love that? You come onto a webinar and I've got a typo there in my title, 5 times when a Roth conversion pays off most. See, I did that on purpose. I wanted to see if you would catch it. And I'm sure that you did, right? Because I just now caught it. And I'm the one that put this thing together. So 5 times on a Roth IRA conversion. So we're talking about converting from a traditional pre-tax IRA to a Roth tax-free or after-tax IRA. And so I've been getting a lot more questions about this lately. From clients in my strategy reviews that we had through the month of May. And so I wanted to kind of address not only that I think it is a good idea in certain situations, but there are certain times when it's even a better idea. And when is it most a good idea? So now may be the best time to consider converting to a Roth. And part of the reason for that is that we right now have lower tax rates. So here in June of 2021, we know that the current tax rates that we have will be where they are through tax year 2025. Starting in the year 2026, the tax rates that were lowered as part of the Tax Cuts and Jobs Act of 2017, they will go back up to what they were before that law took effect. So from 2018 through 2025, that's our window of time. So you've got, including 2021, 21, 22, 23, 24, 25, you've got 5 more tax years to enjoy these lower tax rates. As a result, I've been asking people this question. Forgetting any other considerations for right now, just looking at taxes. When would you rather pay taxes on a sum of money? Now, when you know that the tax rates are lower, or later when you know that they're going to be higher? If you only consider that one question, it's a pretty simple question to answer, right? Most people would say, well, I'd rather pay the taxes when they're lower. Now, obviously there are other considerations, and we're going to talk about some of those. But the point is we may never see the tax rates as low as they are right now again. Not for decades, maybe not ever. So you've got an extremely short 5, now 4.5 year window of time to enjoy these lower tax rates. So let's dive into 5 situations where it may be best, where you can kind of, where it makes a lot of sense to convert from a traditional IRA to a Roth IRA. Now, the first thing that I want to point out is that when you convert money from traditional pre-tax to Roth after tax, it passes through the tax window. When it passes through that window, what happens? You have to pay tax on that distribution. In fact, that distribution converting from traditional to Roth is considered a taxable distribution to you, even though the money is not going to end up in your bank account. It's going to go from, it may even stay with the same custodian like Fidelity or TD Ameritrade or whatever you've got, or your investment advisor. It's going to go from traditional to Roth. You may not even change account numbers, but the tax status of that money is going to change and it will be considered like a taxable distribution to you. So when might it be a good idea to think about this? Well, if you have little to no tax diversification, if all of your money is inside of your 401k, which is pre-tax for most of you, it's inside traditional IRAs, it's inside of a pension, which is pre-tax. If all of your money is tax deferred, and you did that because for years and years while you were building your wealth, and you were putting kids in school and you were trying to lower your tax bill as much as possible, tax deferral was a great thing, right? I'll push that off till tomorrow. I'll push that off for another 20, 30 years. You don't think about it. You reduce your taxable income today because it helps you today. The problem is when you get into retirement, what's going to happen? All of your money is going to be taxable. If all of your money is currently tax deferred, then that means 100% of your money at some point in the future, retirement, is going to be taxable. So what does that mean? Well, first of all, tax deferred money is subject to required minimum distributions. So beginning at the age of 72, for those of you who have not yet reached the age of 70 and a half, starting at the age of 72, you will have to start taking out some minimum sum. How much is that going to be? I don't know. It's dictated by law. Okay, and there's a formula. It's going to be the sum total of all of your tax deferred money on December 31st of the previous year, in the year that you turned 72. And it's going to be divided by some life expectancy factor. And right now, I think that number is like 26 or something like that. And that will determine your required distribution. So tax deferred money is subject to required minimum distributions. Tax deferred money, which is taxed later on in retirement, is going to subject more of your Social Security to taxation. It's going to potentially increase your Medicare premiums, your Medicare Part B and D premiums, because the percentage of your Social Security that is taxed and the amount that you pay for your Medicare Part B and D premiums is dictated by how much other taxable income you have. The more taxable income you have, the more of your Social Security can be taxed, the higher your Medicare premiums can be. If all of your money is tax deferred in retirement, you are virtually guaranteeing that 85% of your Social Security is going to be taxed, and that you may end up having to pay more on your Medicare premiums because your adjusted gross income is higher. So most people have this problem. Most people have this situation. They have no tax diversification. So what are some ways you can do this? Well, we're talking about Roth conversions here, but even setting aside money in a taxable brokerage account, like an individual account or a joint account where you buy and sell mutual funds or stocks, bonds, whatever. By having a bucket of money that is not tax deferred, if it's taxable, well, in that case, you're probably going to be paying more favorable capital gains tax rates or dividend tax rates. Ordinary income tax rates are going to apply to your tax deferred, and those are generally going to be higher for most of you than capital gains rates and dividend rates. So tax deferral is absolutely a double-edged sword. Feels great today. Tomorrow, when you're retired, the bill comes due. And when can you least afford to pay taxes? When you no longer have a guaranteed dedicated paycheck from an employer. When you are in 30 years of voluntary unemployment. That is when you can least afford to pay a bigger tax bill. So again, you want to diversify. You've got tax deferred, but you want some tax-free and you want some taxable. That way, when you get into retirement and you start pulling money out of accounts, your advisor, if they've got multiple buckets to pull from, we do this all the time for our clients. For example, we got a client named Joe right now, and she wants to spend about $300,000 on a new house. She didn't want to have a loan. She wants to pay cash for it. So she came to us and asked us, okay, where should we take the money? Now she's got some tax deferred money, but she's also got some Roth money, and she's got some after-tax brokerage money. So when we start looking at where to take it from, if all she had was IRA, tax deferred IRA money, all of it would be taxable. But now we can pull from some of the Roth, we can pull from some over here, and we can leave the tax deferred money alone. Now, as it turns out for her, she must take required minimum distributions. So the first money we take, let's satisfy the required distribution. Then whatever's left over, we can pull from the more tax advantaged accounts to try to keep her tax bill lower. A big part of your job and your advisor's job in retirement, investments, okay, fine, you got to invest. You know what your biggest job is? Cash flow management for taxes, for timing, things like that, all right? So if you don't have a lot of tax diversification, now may be a good time, take advantage of lower rates and build in a tax-free bucket of money, because distributions from Roth accounts are tax-free. And since they are tax-free, they do not count towards your adjusted gross income. And since they don't count towards your AGI, they will not count towards taxing your Social Security, and they will not count towards increasing your Medicare premiums. That's why I love Roth accounts, especially in this tax environment that we're in through 2025. Another reason, another time it can be really great to convert to a Roth is when you've got some extra cash on hand to pay the tax. So I just mentioned to you, a conversion is considered taxable income, right? So some tax must be paid. But the problem is the tax to be paid cannot be withheld from the converted amount. If you're going to convert $50,000 of traditional money to Roth, if $50,000 was in the traditional, $50,000 must show up in the Roth. Because if you withhold any of that money, that will be considered part of a taxable distribution. There's some other implications there. The point is that what shows up here must show up over here. But when it passes through the tax window, then how do you pay the tax? Generally, you're going to pay it out of pocket. It's going to come from your savings or some other non-IRA account. So if you've got some available cash in the bank, or you've got an investment account with some cash in it, and you've got a spare $10, $15, $20,000, and you don't mind parting with it, you can use that cash to pay the additional tax on the conversion. In fact, oftentimes people will ask me, well, how much am I limited when it comes to converting from traditional to Roth? There is no limitation. There is no maximum when you talk about a conversion. There is a limitation on adding new money. So a contribution is limited to $6,000, or if you're 50 and over, $7,000. Plus, you have to have earned income to be able to contribute money directly to an IRA in the first place. If you're retired, you don't have earned income. So a conversion may be your only way to get money from a traditional to a Roth. And there's no limitation, except for, do you have the cash on hand to be able to pay that additional tax? That's often one of the biggest limiting factors that determines how much you can convert. We have many of our clients that say, you know what, I'm going to set up a tax budget over a period of years. And for 10 years, I can afford to pay an additional $10,000 in taxes. So based on that, we can back into the number, working with their CPA or their tax preparer, to figure out how much can we convert based on that. Also, keeping in mind, we don't want to convert so much that we inadvertently bump up into another tax bracket, all right? Number 3, if you've got after-tax money mixed in with your pre-tax money, all right? So we're talking about traditional IRA money or deductible money mixed in with non-deductible. How in the world does this happen? Well, let's say that you set up a traditional IRA many, many years ago, and you weren't earning very much. You had earned income, so you could make the contribution. And most people don't even think about this, but when you hit a certain amount of income, the more income you have, the closer you get to what we call the phase-out limit. There is a point at which you earn too much income, and if you contribute to a traditional IRA, that contribution is no longer tax deductible for you. We call it a non-deductible IRA contribution. Now, if you make too much income, you also cannot contribute directly to a Roth IRA. Your only option then is you can't contribute to a Roth, and you don't get to take a deduction for contributing to the traditional IRA. So what do? You can still contribute to the traditional IRA, but you don't get to take a deduction for it. That money goes in, and it is considered non-deductible. All right? Now, if you do this later on in life, when now your income is much higher than when it was earlier in life, that is when it is possible to have money that was deductible and is taxable fully, combined with money that is non-deductible, and it just becomes a mess, okay? It becomes a really big mess. The non-deductible money is commingled with the deductible money. And then the other thing is that even though later on, when you pull the non-deductible money out, If you didn't get to take a deduction up front, then that means that it's tax-free when you pull it out later, but only the amount that you put in. Any growth that you got on that non-deductible money is taxable. You see, it creates a huge headache. If you've got an account, an IRA, a traditional IRA, where you've got deductible and non-deductible money kind of mingled together, and you haven't kept records, you don't know what is what and where is where, it's a lot easier managing one tax-free Roth account that you've paid all the taxes on than it is to manage a traditional IRA where you've got deductible and non-deductible money commingled together. Most people do not keep accurate records of how all of this works out, okay? So that could be another great situation where, you know what, I've got the cash on hand. I know it's not going to bump me into another tax bracket. I'm going to go ahead and make the conversion now. Number 4, a great time to consider a Roth conversion is when you believe that the value of your taxable estate when you pass away is going to put you subject to estate taxes. When it comes to traditional IRAs, they can be taxed twice when you pass away. Once with the estate tax, if you're subject to it, and again, when your heirs inherit traditional IRA money. When they have to take that money out, if that money has not been taxed yet, someone's got to pay the tax. It's going to be your heirs in the form of an inherited IRA. And when they start taking distributions from it, whether in a lump sum or over a period of years, they're going to pay taxes on it. You've already paid taxes, your estate has anyway, if you're subject to the estate tax. Why is a Roth conversion a good idea? Because Roth conversions will reduce the value of your taxable estate by the amount of the tax you pay when you make the conversion. So it's almost like removing that money from your taxable estate. So let's say that your taxable estate is $5 million or over $5 million, and you convert enough money and you pay $150,000, $200,000 in taxes over time. That money is deducted from the value of your estate. It no longer contributes to valuing your estate, and it might drop you below the estate tax threshold. Not to mention that that money, once it's in Roth and you've paid the taxes up front, when your heirs inherit that money, it will be tax-free to them because it's in a Roth. We've got a client right now, Gail, who lives out in California. When she passes away, she's going to pass on about $6 million in Roth money to her 3 children. They're not going to have to pay a dime of tax on that money when they get their hands on it because she has planned ahead. Now, right now, the estate tax threshold is just north of $11 million. That means that you could die today and you could have an estate valued at $11 million or less and still not pay 1 dime of estate tax. But here's the problem. That threshold gets cut in half, basically, starting in the year 2025. It's going to fall back to just over $5 million in 2025. I know some of you on the call today have an estate that is worth over $5 million. In fact, many of you do. So while you may not be caught in the estate tax threshold today, here in just a few years, that threshold is going to be much lower, and you have a much higher probability, assuming also that you get growth in your estate between now and then, you have a much higher probability of eclipsing that $5 million threshold and triggering the estate tax. It could go lower. There is a proposal from the Biden administration right now to not only go to $5 million, but to go to like 3.5 or 3.25 million. That will ensnare even more of you. So the point that I'm making here is that if you were to convert some of your money to Roth, that money would have a beneficial impact on your taxable estate, as well as the taxes that your heirs have to pay later on in life. And finally, number 5, reason why it could be a good idea to convert to Roth right now. You believe that your future required minimum distributions will be high. As I've already stated, beginning at the age of 72, you must start taking required minimum distributions from your tax-deferred accounts. All of them. It does not matter what it is. If it's a 401k, a 403b, a 457, a 401a, a TSP, teacher retirement, any kind of pension, okay? You must take money from it. If it's tax deferred, you have to take money from it. And when you take that money, it's going to be taxable. The more tax deferred money you have, the more money you must take. Again, the RMD calculation is based on the sum total of tax deferred money you have on December 31st of the previous year. That's how they calculate that year's RMD. And as your accounts grow in size, and right now, over the past couple of years, the market has gone gangbusters, right? Many of you have probably seen over the last couple of years, we've got clients right now, even at very moderate levels of risk. I would even say moderately conservative levels of risk. We're seeing 14% gains. Now that's unusual, but that's what we've seen in the market. You've likely seen your accounts grow quite a bit. And if that happens over the next 10 to 15 years, whenever you get to that age, those of you who aren't already there, your payment that you have to take is only going to get bigger. Well, the more money you have to take, the higher your taxes are going to be, the higher your adjusted gross income is going to be. And as we've already established, the more taxable income you have, the more of your Social Security can be taxed, the higher your Medicare premiums are going to be. You see, all of this is interconnected. By creating a tax-free bucket of Roth money for yourself right now and over a period of years, and that's what I'm doing. Right now, I don't contribute one dime to my tax-deferred accounts. I have some tax-deferred IRAs. I'm 44 years old. My wife and I only contribute to Roth, and we are converting our traditional money to Roth. Why am I doing this? Because the tax-free growth in my money that I'm going to get over the next 20 years plus is more valuable to me than the tax deduction that I might get today. Now you could make the argument, yeah, but you're sacrificing the growth on all of those tax dollars that you're paying today. I'm willing to make that sacrifice because it's not about just the tax on that money. It's about increasing my Social Security tax later on. It's about increasing my Medicare premiums. There are far more implications in retirement related to taxes than just the tax you pay. And that's what I'm trying to share with you today, is that converting to Roth, does it hurt you today because you have to pay the tax up front? Yes, but the tax rates are lower, and they will be through 2025. When would I rather pay the tax? Now, while I know that the tax rates are lower, okay? So if you have sufficient other income, like many of my clients on the call today, you know what they do with their RMDs? Many of them donate it to charity because they don't need it. But if they take it, they don't really need that income, but they still have to take it. They pay the tax on it. It increases their AGI. It increases the tax on their Social Security, all the things we've talked about. If you have sufficient income from other sources in retirement, RMDs can, pardon my language, can be a major pain in the ass, okay? And people complain about, I got to take this money. Yeah, you do, because if you don't take your RMD, you know what happens? You get a 50% penalty, plus the tax you owe on the distribution you should have taken. Roth IRA accounts have no required minimum distributions. So the government is not telling you when and how much to take your money. Now, before you convert, nothing is ever simple, right? It's never, well, if this, then do that. There are always considerations. I've given you some reasons why it could be a good idea to convert to Roth, but you also need to consider some other things. For example, if you convert $50,000, is that going to bump you into another tax bracket? If it is, then you need to talk with your CPA, talk with your financial advisor, find out how much income can you convert, or how much can you convert, how much additional income can you report on your tax return without going into the next tax bracket? Do you have the available cash on hand to pay the taxes? Just because right now is a great environment to convert to Roth does not mean that I want you to sacrifice your cash position to be able to do it. We would accomplish one goal, but now you're cash poor because you drained your savings to do it. I don't want to do that to you either, right? So again, I don't want to go into another tax bracket. I also don't want to use up every bit of my cash. So how much of my cash am I willing to part with? And that helps you to determine how much to convert. And how will the additional income that you're about to report due to the conversion, how will that impact your Social Security benefit from a tax standpoint? Will it increase your Medicare premiums? Things like that. You always, always should consult your financial advisor and your CPA before you execute a Roth conversion, because they can talk through some of these strategies with you, all right? So we've got just a few minutes here. I would like to invite any questions that you might have. You can ask a question through the Q&A function down in your little toolbar down there. If you've got any questions on Roth conversions or anything really, you can use the Q&A function. You can also use the chat function. So right now is a great time to submit any questions that you might have if you've been considering a Roth conversion and you want to ask about it. While you are thinking of your questions, I want to share a couple of announcements with you, all right, as I always do. So the first thing, please share your questions and thoughts. And that's another thing. Maybe you don't have a question, but maybe you've got a Roth conversion tidbit. Maybe you have a Roth conversion horror story. When you did it, you regretted doing it. You know, I mean, that's possible too. But while you're thinking of a question or a thought, I must tell you about something very exciting that is coming. Victoria and I, Victoria Woods, that you see right there, many of you have met her, some of you have not. But we have a new television show that is going to launch on Sunday, June the 13th. It's called It's All About the Money, Honey. So it's basically a television version of our radio show. And you can see a picture of us right there. That's actually in the studio when we went to record the first 6 episodes of the show. But it's a 30-minute television show that's going to air every Sunday in the Oklahoma City area at 11 o'clock. And it's going to debut Sunday, June the 13th on KWTV News 9. That is the CBS affiliate for those of you who are unfamiliar with the Oklahoma City area. Let's see, we do have a comment here. Oh, Ellen says, congratulations on the new TV show, Damon and Victoria. Thank you, Ellen. Appreciate that very much. Yeah, we're really excited. You know, we had to do the makeup and the hair and all that. And of course, look at this hairline. You can tell there's not a lot of hair work to be done for me. In fact, the makeup person, there was a woman doing the makeup, and every so often she had to come in while I'm sitting there at the desk in between segments, and she had to keep spraying this stuff on my hair so that the glare would not bounce off and look like I've got the sunrise coming up on my scalp. That was a little embarrassing, but you know, it is what it is. I'm going to go bald someday, so I got to make my peace with it. But you know, surprisingly, we've done the radio show for a long time, and I didn't find it to be that big of a transition to go to television. The only difference is you got cameras all around staring you in the face. But if you're in the Oklahoma City area, every Sunday, tune to Channel 9 in Oklahoma City and at 11 o'clock, and you will see our show, It's All About the Money, Honey. Now, after each episode airs, we will be releasing them on our YouTube channel, Financial Diva. So those of you who don't get to see it live on Sunday, if you're not here local or you just can't be around your television, you'll get to see that on our YouTube channel. And if you go to Financial Diva, the Financial Diva channel on YouTube, and subscribe and hit the notification button, you'll get notified every time we upload a new video. But what I want to ask you right now is, if you have any questions that you would like us to feature on future episodes of our show, email me at damon@chappelwood.com. I'll be happy to feature them, and I'll be happy to give you the credit for it, because we're always looking for new, fresh content. And our show is just like our radio show. It's far more interesting when we are discussing the questions you ask, as opposed to some crap that happened in the stock market that week. I mean, I know that's important, and you want to hear that. But, you know, most people want to hear, okay, I get what the stock market's doing. Apply that to me from a practical standpoint. How does that impact me? And the best way that we can share that is through stories. stories like yours, questions that you have. So if you've got any questions that you'd like us to feature on the show in the future, please email me at damon@chappelwood.com. Let's see here. So Lynn says, thanks for covering this today. So let me understand. If I sell some stock, pay taxes on the sale, I can't use that money to pay taxes when I convert IRA to a Roth account. That is not necessarily true, Lynn. So this is a great question. Okay, so remember I said that if you convert X amount from traditional to Roth, the same amount has to show up, right? That tax has to come from somewhere. It cannot come from the conversion. Now, it can come from cash that you have sitting in the bank. However, if you have another investment account like a brokerage account, you can go in and sell some of those stocks to raise up cash to pay that tax. That is absolutely something that you can do. Now keep in mind, if you go and sell some assets inside of a taxable account and you recognize a gain, well, you're also going to generate capital gains taxes, which depending upon how long you held that could be taxed at ordinary income tax, could be taxed at 15%. My recommendation is if you're going to sell assets to pay the tax for a Roth conversion, make sure you are selling assets and raising cash that are long-term assets. You want to make sure that they qualify for long-term capital gain treatment. And long-term is considered you've held on to that asset for at least a year and a day. Not a year, but a year and 1 day. That is long-term. That way, you'll get the more favorable 15%, or depending if you're at the top tax bracket, 20%. But most of you are going to pay 15% for long-term capital gains. So yes, Lynn, you can absolutely sell assets inside of a taxable account, raise the cash to pay the tax for the conversion. Just understand you might generate some additional taxable income. But that's a great question. Jennifer says, very exciting. Happy for the ChappelWood family as well as for the Oklahomans who will be watching. Thank you, Jennifer. Hope you and Doug are doing well today. Appreciate you being on the Lunchtime Drive-Thru as well. Lynn says, great info. You're welcome, Lynn. And I know I got your email, and I know you're considering the Roth conversion, but we're going to hold off for a little bit, and I'm glad. So see, Lynn is smart because, and all of our clients are geniuses, okay? All of our clients are successful, genius people who are amazing, and they're all people that you would want to have over at your house for dinner. And to have a beer with too, if they drink beer, or bourbon in my case. But Lynn was smart. She went to her CPA and talked about doing this. We had already talked about a conversion strategy, but she went to her CPA, and her CPA says, you know what, there might be some tax legislation coming down the pike later on down the year. Let's wait a little bit to see. And part of the reason is that some of that legislation may be retroactive. And if we convert now, but then somehow some of those beneficial rules are changed and they're retroactive, now we've converted and maybe we don't get the benefit we wanted. So those are always reasons why you want to talk with your advisors before you do anything. All right, well, we are coming up, we're actually a few minutes past the hour here, and I appreciate all the questions. The last thing that I'm going to tell you about, I'm very excited to let you know that our class, Rock Your Retirement, is no longer on Zoom. We are now going back live to the University of Central Oklahoma, so live and in person. The bad news is, for those of you who are not in the Oklahoma City area, it's harder to attend the class. But the good news is that for those of you who don't really like the online experience, you're kind of zoomed out, you're okay with 30 minutes like this, but for 4 hours, you'd rather be face-to-face. We're going back on June 17th and 24th, back at the University of Central Oklahoma in a classroom. I'm limited to the first 16 people that enroll in my class. Now, if you're a client, you can come free anytime you want. You just let me know. Everybody else, it's $49, and that gets you and a guest into the class. You both get a workbook. And we talk about everything you need to know to prepare yourself for retirement. Go to ChappelWood.com to get enrolled in that. So you can do that. But also, if you've got a question for the television show, email me at damon@ChappelWood.com. We don't have any more questions for today. So with that, we're going to bid adieu. I appreciate you being here this afternoon. It's good to be back for the drive-through. We're going to be back all through the summer. And so stay safe. Enjoy your the rest of your week. Enjoy your weekend. Let's see, we do have one more comment here. Great info. Thank you. You're very welcome, Lynn. And I want to thank you and everybody else who joined us for the drive-thru today. Stay safe. We'll see you next time on the Wednesday Lunchtime Drive-Thru. Thanks so much. Have a great week. Bye-bye.